Well, the euro, seen as a potential failure just 10 months ago, had its strongest start to a year on record. Joining me again is John Taylor, the founder and CEO of FX Concepts. And in case you don't know, John runs the world's biggest currency hedge fund with $8.5 billion in assets under management. So, of course, you want to hear what he has to say about the currency markets. John and Dom are with me as well, of course. And the last time we had you on, John, I think you had predicted that the euro would continue to rally. There might be a brief respite in April, but it would continue to go ahead. Right?
Right, yeah.
Is that still your forecast?
Yes, it is, for a short time. I mean, it's got another 3 or 4 months to go before I think it's over.
What do you make of this rally that we've seen so far?
Well, a lot of it's just because Trichet is going to raise rates, and certainly Bernanke is not, right? And so that's the difference.
So it's the interest rate differential. Does it have much to do with growth in Europe?
No.
At all?
No, I mean, the weird thing about Europe, of course, is you have Southern Europe in a recession and you've got Germany powering ahead. I mean, Germany ought to have interest rates of 5 or 6%, and Southern Europe ought to have interest rates of 0. So that's a real problem.
Well, John, I mean, a lot of analysts, a lot of economists out there have talked about the demise of the euro, through all of these stresses that we've seen here. Obviously nobody's making that speculation right now, but is that a case, is there a case to be made for a weaker euro simply because they can never have this cohesive element to a currency that other currencies and countries have?
Yeah, I think there's a case in the long term. My argument is that the euro has to have a real crisis that comes before the euro is reborn as maybe a smaller euro, as a more federal euro. But there's a crisis coming, and during that period, you don't want to own it.
The crisis, though, I mean, we've seen mini crises so far, right? In Greece, the latest has been Portugal. Now we're talking about Spain. What is it going to take, though, to rethink the euro then?
Well, I think it really means the fall of governments, the people in the street marching and
but
threatening.
All of that, John, right?
Well, governments have fallen. Big deal. We've re-elected new guys. No, I mean really falling, where there are people out there with,
You mean like
with
an
clubs.
Egyptian-style collapse?
Yes. Not quite, but something that's a little more civilized, but nevertheless pretty grim.
John, how does this affect your outlook for stock markets? Heading into this year, you had some bearish views on the DAX. In part, you mentioned Germany earlier, in part because of this euro move. What are you thinking now about how, if the euro is going to continue to climb for 3 to 4 months, how that's going to affect different stock markets?
Well, I must say that, for me, it's rather confusing. I mean, I like the U.S. stock market because our interest rates are 0, in effect. The dollar is weak. That means it's great for the exporters, and it's good for, reported earnings. And Germany's got the opposite, so therefore the DAX ought not to be looking very good. And when you look at it, it's not quite as healthy as it used to be, but it's still looking pretty good, and I'm wrong, right?
Hey, John, I mean, one quick thing here. Along the stock lines, we obviously know that currency markets dwarf stock markets all over the world. Do you think that currency market is going to keep on growing and growing? We're already talking about trillions and trillions of dollars exchanging hands. How much bigger can it get?
Well, it's pretty big. I mean, at $1 trillion about 8 or 10 years ago, I was kind of like saying, well, geez, that's a lot. Now it's 3. And this is every day. So, the European Parliament voted a Tobin tax, but of course the European Parliament has no power, one of the problems in Europe. And that Tobin tax, which would tax every foreign exchange transaction, would throw the whole business into the ash bin. So things can change here. It's pretty big, and it is the tail wagging the dog now.
John, if you were short the dollar, the U.S. dollar right now, would you want to start covering those shorts in anticipation of a Fed rate hike?
Now, my previous experience, and there's been a lot of it, has been that you don't ever do anything until you're really about to go over the edge of the cliff. So therefore, we're short dollars and enjoying it, even though we say, well, there are reasons maybe why this might not be a good idea.
And what about the euro against other currencies? Do you think there's a certain currency it's going to do a lot better against than, say, another?
Yeah, I don't think, for instance, the Eastern European currencies, the Hungaries and the Romanias, places like that, and Turkey are doing much better than the euro, and also Australia and New Zealand, I think, will do better than the euro.
John, right in the commercial break, I was asking you, what else are you short? Because you said you're short the U.S. dollar, and you basically had a hard time figuring out, if there really are any attractive shorts out there. Is that unnatural? I mean, what does that tell you about the state of the global economy? The fact that you're having a hard time finding any shorts anywhere?
Well, what it tells me is that the global economy is very good, because because the U.S. is pushing all this money out, and people are happily selling it and buying their own currencies, and so it means everything is going well. That's it. There's just money out there.
Okay.
I mean, John, speaking of shorts and the people who are making money on it right now, people who are short the Japanese yen seem to be kind of taking some profits here, making some money, right? Is this a trend, or is this something that we're going to see kind of just fizzle out as the central banks all get together and try to weaken that currency there? I
mean, I think this is the biggest battle that we have among foreign exchange traders and analysts at this moment, is what's going to happen here. Historically, if you look at the Kobe earthquake, the Japanese yen strengthened tremendously during the next 3 months after that earthquake. And it strengthens because the Japanese have to bring their money home. They get scared, they get nervous, they don't want to invest offshore in South Africa or New Zealand or something. So they bring their money home, and that makes the yen go up. I think that's the natural reaction to things. So the central banks came in and said, no, it's not going to happen this time. And so far they've been correct. And other people have agreed with the central bank, saying, well, gee whiz, this earthquake is so much worse. The nuclear situation is so bad that it's going to cut electricity production, it's going to cut exports. And so Japan should be weak. So which is right? I don't know yet. Right?
You don't have an opinion on whose side you fall on then?
Well,
whether or not it was right for them to intervene?
Well, I think it was right for them to intervene, because it would have been disastrous for the yen just to keep strengthening up to 70 or something. But whether they're going to win is something else. I mean, because if all the Japanese are bringing their money home, I mean, how much are the central banks going to do this?
Right, they dwarf in comparison to that.
Exactly, yeah.
What is your bet on the yen then? Well,
we're actually short yen, but I must say that we were long, going into this and through the 76 and only began to get short. And we're not really short yen compared to we're short so many things against the dollar. The yen is not a big effort for us.
John, earlier on in the loop, we highlighted that there are a lot of Wall Street analysts who think that trading numbers for all of Wall Street are going to be weaker than what we previously thought. What about in currency trading? Is this going to be a big quarter? Is it a lousy quarter? And if so, why?
I think certainly the last quarter was a good one. The banks are complaining a little bit because we're all going electronic. So they don't get to see the action on the trading desk, and they can't make as much money off of us on the other side of the market. But I think the volumes are very large this quarter.
John, last time you were on, I think it was earlier in March, you were talking about an oil price. Oil prices were your biggest concern.
Right.
That's what's going to dip us into a recession. Give me your update on that forecast. You still think that that's going to happen in the latter half of 2011? Yeah,
absolutely. I mean, oil, if you look at oil, oil goes up, and eventually 6 months later or so, the economy goes down. And how high is oil going to go? I mean, obviously it went to 140 in the summer of 2008.
2008, yeah.
And we're only at 108, although if you look at the Brent, we're at 120. We've got a little bit more to go, I think, because I think the economy is going to look fine this quarter.
Well, do you have an outlook on when we tip into recession for the price of oil?
Well, my outlook on the economy was, at the beginning of the year, was 4.321,
right, going
down each quarter. Well, the first quarter is coming in at 2.5. Now, all the optimists are saying, well, the next quarter will be 4 still. Goldman Sachs went to 2.5 on Friday, so we have good company in there. Yeah. But they're sticking with 4 for this quarter. But they're nervous, right? I mean, so I would argue that they've got good reason to be nervous. We'll probably come in at 2, but that's strong enough because China's growing, et cetera, to drive oil up.
John, great for you to stop by. Thank you very much, John Taylor of FX Concepts.